What is Buffett's solution? He built a stack of 10 specific moves, ranked from the safest on earth to the ones quietly compounding into life-changing wealth. That's exactly what we're breaking down today. Option 1, U.S. Treasury Bills, ranked safest. What it is: short-term government debt, backed by the full faith of the U.S. government. Maturities of 4, 8, 13, 17, or 26 weeks. Current rate, 4.9 to 5.1% APY as of June 2026. Who it's for: anyone who wants to park cash with zero default risk and full liquidity. Minimum, $100 via treasurydirect.gov. The catch: rates float. When the Fed cuts, your yield drops with it. Berkshire Hathaway holds $314 billion in T-bills as of Q1 2025. That's not a hedge, that's a strategy. Buffett has called T-bills the closest thing to a risk-free return that exists. Option 2, high-yield savings accounts. What it is: FDIC-insured savings accounts at online banks paying 10 to 15 times the national average. Current rate, 4.5 to 5.0% APY as of June 2026, top online banks. Who it's for: anyone needing instant liquidity, emergency funds, short-term savings goals. Minimum, $0 to $1 at most online banks. The catch: rates are variable and will follow the Fed down. Not a long-term solution. Buffett keeps Berkshire's operating cash in instruments exactly like this: liquid, safe, and always ready to move when opportunity strikes. Cash is like oxygen, he said. You never think about it until you need it. Option 3, money market funds. What it is: mutual funds investing in short-term, high-quality debt. Not to be confused with money market accounts, which is bank product. These are brokerage-held funds. Current rate, 4.8 to 5.1%, 7-day yield as of June 2026. Who it's for: investors with brokerage accounts who want a safe, yielding place to park uninvested cash. Minimum, typically $1,000 to $3,000. The catch: not FDIC insured. Extremely low risk but not zero risk. Berkshire's cash holdings flow through instruments in this category. The goal isn't to earn a fortune on cash, it's to preserve purchasing power while waiting for great deals. Option 4, certificates of deposit. What it is: time deposits at banks or credit unions. You lock in a fixed rate for a fixed term, 3 months to 5 years. Current rate, 4.5 to 5.0% APY for 12-month CDs as of June 2026. Who it's for: people with known future expenses, a down payment in 12 months. Fixed timelines, fixed rates. Minimum, $500 to $1,000 at most institutions. The catch: early withdrawal penalties can erase months of interest. Your money is locked. Buffett himself doesn't use CDs, he prefers the flexibility of T-bills. But the principle is identical: get paid while you wait. CD laddering mimics exactly how Berkshire staggers T-bill maturities to maintain constant liquidity. Option 5, I bonds, Series I savings bonds. What it is: U.S. government bonds with a yield tied to inflation. Rate resets every 6 months based on CPI. Current rate, 3.11% composite rate as per May 2026 reset. Who it's for: long-term savers who want guaranteed inflation protection. Think 5-year plus horizon. Minimum, $25 via treasurydirect.gov. The catch: $10,000 annual purchase limit per person. Must hold at least 12 months. Redeem before 5 years and you forfeit 3 months of interest. I-bonds solve the problem Buffett describes as the investor's silent enemy, inflation. With CPI at 3.8% and savings accounts at 0.61%, the math on I-bonds is simple: you're guaranteed to at least stay even. Option 6, dividend growth stocks. What it is: shares in companies with long track records of paying and raising dividends every year. Current rate or return, 1.5 to 4% dividend yield, plus capital appreciation. Who it's for: investors with a 5+ year horizon who want income that grows faster than inflation. Minimum, cost of one share. Many brokers offer fractional shares. The catch, stock prices fluctuate. Dividends can be cut. Requires patience and the stomach to hold through downturns. Berkshire receives $816 million per year in Coca-Cola dividends alone, on an original investment of roughly $1.3 billion made between 1988 and 1994. Buffett paid for Coke once. It has been paying him back every year since. That is the dividend compounding machine in its purest form. Option 7, S&P 500 Index Funds. What it is: funds tracking the 500 largest U.S. companies. 1 purchase. Instant diversification across every major sector. Current rate or return, VOO 10-year average return, 15.28%. Who it's for: long-term investors who want market returns without picking stocks. This is the option Buffett recommends to almost every individual investor. Minimum, cost of one share of VOO approximately $530 as of June 2026 or $1 with fractional shares. The catch, not a short-term vehicle. In a down year, you're down with the market. Requires the discipline to hold. In his 2013 shareholder letter, Buffett wrote that when he dies, 90% of his wife's inheritance should go into a very low-cost S&P 500 index fund. He specifically named Vanguard. He repeated this advice at nearly every shareholder meeting since. This is not a suggestion. It's the only stock tip Buffett consistently gives ordinary investors. Option 8, Real Estate Investment Trusts, REITs. What it is: companies that own income-producing real estate, apartments, offices, data centers, cell towers, and are required by law to distribute 90% of taxable income to shareholders as dividends. Current rate/return, 4 to 6% dividend yield as per diversified REIT index, as of June 2026. Who it's for: investors who want real estate exposure and income without buying property or dealing with tenants. Minimum, cost of one share or ETF unit. The catch, REITs are sensitive to interest rates. When rates rise, REIT prices typically fall. Dividends are usually taxed as ordinary income, not at the lower qualified dividend rate. Buffett generally prefers owning businesses outright over REITs, but the principle, own income-producing assets that distribute cash flow regularly, is pure Buffett philosophy. Option 9, Berkshire Hathaway Stock, BRK.B. What it is: buying shares in Buffett's own holding company, which owns Geico, BNSF Railway, See's Candies, and major stakes in Apple, American Express, Bank of America, and Coca-Cola. Current rate/return, 20% average annual return since 1965 historical. Who it's for: investors who want Buffett's judgment managing their money without picking stocks themselves. Minimum, $4.90 per share for BRK.B as of June 2026. The catch, Berkshire's size makes the outsized returns of earlier decades nearly impossible to replicate. No dividend, Buffett reinvests all earnings. You're not just buying a stock. You're buying Buffett's 60 years of allocation decisions, his team, his portfolio, and his philosophy, all in one ticker. Option 10, Private business ownership or cash-flowing assets, ranked highest yield or highest complexity. What it is: owning a business, or a stake in one, that generates consistent free cash flow. This is how Buffett built Berkshire from the ground up. Current rate or return, highly variable. Successful small businesses often generate 15–30% plus returns on invested capital. Who it's for: experienced investors or entrepreneurs willing to do the work of ownership, management, or deal evaluation. Minimum, varies enormously, from buying a local service business to franchising to acquiring a minority stake in a private company. The catch, illiquid. Time-intensive. Most businesses fail. Requires skills, judgment, and stomach that took Buffett decades to develop. This is the original model. Buffett didn't build his wealth through the stock market, he built it by buying entire businesses at prices below their intrinsic value and letting them compound. The stock picks came later. The best investment you can make, he said, is in your own abilities. 10 options. Safest to highest yield. The same framework Buffett uses whether he's parking $314 billion in T-bills or collecting $816 million in Coke dividends every year. The question isn't which one is best. The question is which one is right for where you are right now, your timeline, your risk tolerance, and how much work you want to do. Start with what you can act on today. Then build from there. If this helped, subscribe. Video 2 breaks down the T-bill versus CD versus money market matchup in full detail. We're running the actual numbers so you don't have to.